Good morning, everyone. My name is Sriram from the Commodity and Currency Research Desk. This is the Commodity and Currency Outlook for 23rd September 2022. So, starting with the commodity side of things, starting with energy, international oil prices, along with the domestic side, ended higher on Thursday's trade as the market focused on Russian oil supply and rebounding Chinese demand side of things. Supply constraints from OPEC also lend support as exports from the cartel have definitely leveled off over the last few days, and that too pushed prices higher. Natural gas prices remained weaker on Thursday's trade, pressured by bigger than expected storage build. The latest EIA data showed that US utilities injected about 103 BCF gas into the storage, well above the market expectation of 93 BCF. Looking ahead, we see that crude oil prices can remain range bound and remain supported this Friday's trade amid reports that the Iranian nuclear deal has stalled due to Tehran's insistence on the closure of the UN nuclear watchdog investigations. Rebounding demand from China and lack of supply from Russia will also continue to lend support to crude oil prices. Natural gas, on the other hand, recovered this Friday's trade, but upside can remain capped amid bearish outlook expectations that demand will slow down in the month of October due to maintenance in many refineries going forward. So overall, we see markets can await fresh triggers possibly next week. The main trigger for the markets can be the non-farm payroll numbers. Moving to gold and silver, of course, it was an eventful week for gold and silver. The Fed continued its path of aggressive monetary policy tightening. It hiked rates by about 75 and provided a hawkish outlook for the coming two meetings. Furthermore, we expect that the Fed will continue its aggressive policy tightening going forward, and another 125 basis front loading of rates is possible, which will definitely weigh on gold and silver prices. However, domestically, we have seen a recovery of gold and silver. Again, the rupee has weakened significantly, and that is one of the major supports for the domestic gold and silver prices. But internationally, prices continue to struggle below the important crucial resistance of 1720, 1730, which remains the major hurdle for the markets in the coming few months. And that will be the key trigger to look out for. Of course, markets now could be dependent on the data points. As I mentioned earlier, the non-farm payroll next week will be a key trigger for the markets, at least from the gold and silver perspective. So till that time, we feel markets can remain range bound. Investor demand continues to remain on the weak side of things. Latest data from SPDR showed that gold SPDR fund has fallen significantly over the last few days. In fact, the latest data suggests that investors have definitely taken out of money from the ETF side of things, and further exit of ETF outflows from the funds will definitely weigh on sentiment. So that will be also a negative trigger point for the gold and silver markets over the coming few days. But over today's trade, we can see markets remaining range bound. Domestically, we definitely see that the rupee's support can keep the downside limited for the domestic gold and silver prices. On the international side, the movement can depend on the dollar going forward. The dollar has remained slightly on the subdued side this Friday morning, but we see the dollar downside will remain limited amid extremely hawkish Fed, and that will continue to keep the upside limited for gold and silver. On the base metals, copper and aluminium rose on Thursday as the dollar eased from the highs in yesterday's session, but optimism of further stimulus from the Chinese authorities lifted sentiments. Shanghai announced 1.8 trillion yuan investment worth of infrastructure projects, heeding national policymakers' calls to revive the sluggish economic growth in the country, which is ravaged by the COVID infections. Additionally, LME copper inventory has definitely fallen and represents only just 2 days of worth of global usage, and this also lent support to the copper prices in yesterday's trade. Looking ahead, we see copper and aluminium continue to remain range bound. Further stimulus by the Chinese authorities can support sentiments, but a strong dollar and due to a hawkish Fed will limit upside for the copper and aluminum prices. Moving to the currency and bond side of things, beginning with the currency, the rupee tumbled against the dollar to new record lows on Thursday's trade as risk appetite weakened after the US Fed gave a hawkish outlook on future rate hikes. The rupee settled at 80.86 against the US dollar, weakening from 79.97 in the previous session. Most Asian peers were weak against the dollar and also weighed on sentiments. On the international side, the dollar index surged higher while the yen appreciated by about 1% in yesterday's trade after monetary authorities intervened in the FX market for the first time since 1998 to stabilize the weak currency. However, the Bank of England maintained their, or I should say, hike rates by about 50 basis points, much less what the market was expecting to cool inflation. But the Bank of England also added that they will respond forcefully if needed and if inflation takes a worse turn going forward. So overall, most of the central banks continue with their aggressive monetary policy tightening. We have witnessed the Swiss National Bank also hiking rates along with the Norway National Bank. So most of the banks are tightening, and we expect a similar pattern happening in the domestic market as well. We expect the Reserve Bank of India continue to tighten going forward. We expect a 50 basis point when the Reserve Bank of India meets next week. So this can be a supporting factor for our currency, but the rupee has opened weaker and could continue to remain weaker as investors expect that the Fed will front load interest rates to cool inflation further in the coming two meetings. That will continue to push the dollar higher and weigh on sentiments. Additionally, US Treasury yields continue to move higher, and dollar demand from importers also can keep the rupee under pressure over the next few trading sessions. We can also expect further importer activity at current levels who have missed out over the last few sessions. Importers' demand for the dollar will continue to push the pair even higher, and of course speculators could also test the Reserve Bank of India. The Reserve Bank of India has been promptly intervening and possibly if further weakness is if indeed it comes, then we see that the Reserve Bank of India will be proactive again and intervene in the markets to support the currency. Overall, we see markets remaining under pressure going forward ahead of important non-farm payrolls next week. The dollar index remained subdued this Friday's trade as markets will look ahead to fresh cues. On the bond sides, briefly, we see that US bonds continue to remain elevated in yesterday's trade and possibly can remain elevated in this Friday's session, which will have an impact on our bond yields as well. Indian bond yields also rose in yesterday's trade, tracking the international market. So we see the bond yields also remaining elevated going forward. But the main trigger again for the currency and the bond markets can be the non-farm payroll numbers, which is due next week. So that's it from our side. Thank you for listening. Have a pleasant day and a great weekend ahead. Thank you.